This is the Econ Americas podcast. I'm so pleased to be with you and thanks for joining us. We explore paths to financial freedom, and we have another wonderful guest, an old colleague or friend of mine who works at the American Institute for Economic Research, or AIER. That's been Great Barrington, Western Massachusetts. He is the Director of Economics and Economic Freedom, so right up our alley. He holds a doctorate in economics from the University of Angers. And he has a new book out, just out last month. It is called Gold in Uncertain Times. I've been reading it, and there's no, look, we go right to the heat of the meat here. Gold, the most, recognized source of financial freedom or wealth protection. So his name is Peter C. Earle. We'll call him Pete today. Peter C. Earle, because there are a few other Peter Earles out there. Look him up on Amazon.com. And just quickly, is there a digital version available for purchase? Or because I only see the print version on Amazon?
There will be. It's just not out yet.
Okay, just in the formatting. Okay. So, Peter, please tell us, you've been studying finance economics for many, many years. What makes this book timely, right? You say in uncertain times. What was the catalyst for releasing this book right now? And it's relatively concise. I think around 150 pages. Do you want to confirm?
Yeah. So I mean, AIR's history is very closely entwined with gold. But what we're seeing right now in the gold markets is a structural repricing rather than one of these short-lived kind of spikes we get when there's uncertainty or a recession or something. And that repricing that we see, which has gold at about, I think last I looked, it was 43.10. It's been as high as 43.50, right? That's being driven by persistent fiscal deficits, high debt, a lot of geopolitical fragmentation, and a lot of growing skepticism about the potential for long-run monetary discipline. The Fed has a very strong inflationary bias, and there's no incentives that it has or no real forces that are going to push it away from doing that. We've seen tremendous central bank purchases of gold for a few years now, really started in the first quarter of 2022 when the U.S. kicked Russia out of SWIFT. That was a warning to both adversaries and allies of the U.S. alike that relying on the dollar, relying on the dollar, which is of course the global reserve currency, could be risky. So a lot of countries, even some of our allies like England and some others, have upped the percentage of gold in their financial in their national assets to hedge away from the possibility that their dollar exposure could put them at risk. So that's been the dominant marginal source of demand. And that's, at the same time, gold is resilient, even as equities have performed well. And so it's being treated less right now as a crisis hedge, such as it does when it spikes, and more of a strategic asset, both for individuals and for nations alike.
Okay. Now, how closely do you personally follow the Federal Reserve's actions?
Pretty close. I mean, I read the statements every time they do every time there's an FOMC meeting, and I watch, things like when they just decided that they're going to start using the balance sheet tool again and some of their policies. So I watch the Fed pretty closely.
So not only the public statements, but also their actions. Okay. Do you want to comment on the way we've got to a point where even though there is a reported 3% inflation rate, there's still a lowering of rates? Doesn't it seem confusing? Yeah.
Yeah. Oh, it does. I mean, what it means is that once again, the dual mandate, which is to, keep prices stable, which means to keep an eye on a stable general price level, and at the same time to stabilize employment and to keep the job market strong, is regularly in conflict. And what that means is that occasionally the Fed has to choose between one or the other. And I think it's very clear in the past 2 months, the past two meetings, they've chosen employment over prices. So that's why they're lowering right now. I think they lost precious time to address softening in labor markets, and they're on top of it now. They say they're data focused, but I think they're looking more closely at non-farm payrolls than they are at the inflation numbers.
Right, and you mentioned just before we started recording that you work on the Everyday Price Index at AIER. So go to AIER.org. It has an incredible history. This organization, the founder who died now 45 years ago, but he leaves an incredible legacy. I've had a couple of stints there. It's a beautiful place. Now, the everyday price index. Do you want to clarify what that is? And we're getting a bit away from your book here, but what that is and what it is telling us, distinct from, let's say, the normal figures.
So when you look at the CPI index, that's the consumer price index that's put out by the Bureau of Labor Statistics. That's an index that's made of thousands of different components, whether it's types of food, services, all that sort of thing. There's a goods and services component, but the high level CPI, whether we're talking about core or headline, which includes food and energy, is full of thousands of different components, all sorts of things. What I do with the everyday price index is I take 24 categories of price, which are things that basically every household buys. It's food, it's your utilities, it's different things like that, right? And what we do is we calculate the inflation cost based on that. And what we regularly find, especially we found this in the summer of 2022 when inflation went up to 9%, is we regularly find that the everyday price index is moving a lot more than the CPI. So, basically, you could infer from that inflation is usually pretty much worse for the family, for the household, than the CPI is telling us.
The 2022 trucker convoy showed many Canadians had reached their limits. The convoy's participants encountered persecution from Ottawa and wondered what to do next. Financial Sovereignty for Canadians assists those looking to take direct action, and it outlines practical strategies. These include wealth protection with precious metals, the swiftest path to the United States, expatriation options in the Americas, censorship-resistant cryptocurrencies, and even the case for provincial independence from Ottawa. This book is a gateway to reclaiming your sovereignty, to being an economic driver and not a passenger. Buy it on Amazon.ca or click the link below.
I looked at this recently and noticed that meat, including poultry, is going up at a faster rate. That's one of the real drivers. And I just thought, what is not going up? What is going down in price, right? If household items are going up, what is not going up?
There was one thing I had an article last week. I can't remember what it was. There's one thing where prices are lower now. I can tell you this: prices of bananas and coffee have risen more in the last 11 months than they did in the entire 4 years under the prior administration. That has a lot to do with tariffs, but it also has a lot to do with prices of shipping and also just general, prices of labor.
Yeah. So, and this does lead in really well to your book because, of course, gold has this special role in fighting or resisting inflation, and we really are in an odd moment in history where it just seems like confidence in fiat currencies really is fading away, including the US dollar. And who knows what comes next? I don't know. I wish I did know. I don't, right?
We'd be rich if we knew.
Yeah. I mean, if we knew which altcoin, for example, would really be taken on as some kind of transaction for transaction purposes or stablecoin or whatever, that would be great. But there are just so many out there, and Bitcoin has shown and that it has not, whoever is developing it or allowing it to evolve is not letting it evolve in a way that allows day-to-day transactions.
You're absolutely right. Yep.
Now, so gold in uncertain times, we are in uncertain times. And so you've gone back to basically the basics of what gold is and why it stands out. And then there's the fascinating evolution of ownership potential or avenues in this time. So why don't you go quickly, just tell people, why is gold such an intellectual interest for you?
As I commented in the beginning of the book, I landed on a trading desk just short of 30 years ago. And I think I would have been shocked at the time to find out that in this era of high tech stuff and all these other, just the modern innovative technological world, that gold would still have a role. But the fact is that, gold has probably hasn't recently been as relevant as it is now. It was probably this relevant, maybe you could say in COVID, but certainly, back in the 1970s. And, it's best understood, I think, as a form of financial insurance rather than as a growth asset. Most of the time when people put a portfolio together, when asset managers, deal with gold, they compare it against bonds or stocks or sort of thing. But it serves, I think, a fundamentally different role than stocks or bonds or those sorts of things. It doesn't generate income. It doesn't generate earnings. I mean, it doesn't even benefit directly from economic expansion, but its value lies in its diversification rather than return maximization. And so, I think what we're seeing now is that just as historically, gold has always performed well when confidence in monetary or fiscal management or just government generally erodes. That's why we're seeing this boom right now. And as I said at the beginning, I have to reiterate, this is a structural change. I don't think this is just a spike and we're going to see gold back down at, $1,800 or $1,900 now. What do I know? We may, but my strong opinion is that this is a shift. This is a structural change.
I agree with you. And just over a year ago, I wrote about how, back during COVID, it was, I think, 2,300, and we were all getting very excited. And I wrote a year and a half ago that the run has only just begun, basically. Now, I wouldn't write that again. I wouldn't write it right now.
Right.
But I agree that
Yeah.
there's been a structural change, and I just think gold is more valuable relative to other forms of wealth acquisition or in a portfolio than it was a few years ago. And we can all just see that the sustainability of these modern welfare states, maybe they were never sustainable, but right now it is becoming more apparent to people that they've encouraged, let's say, early retirement, lack of productivity, redistribution, and a war between the generations. And the interest burden is just cataclysmic. Plus, so much of what people pay for their taxes and they assume they're getting back in public services are really just redistribution to pension schemes now. So, do you want to give us a few thoughts on, we're speaking with Americans and Canadians mostly, or that's the audience, but what is the future? Are we just going to be, just higher inflation permanently embedded in our lives? Is that the reality we're facing?
If we assume that there's going to be no change, and right now there's absolutely no incentive on either side of the aisle in the US to stop spending. Republicans spend a lot, Democrats spend a lot. It's not even that they spend on different things anymore. Some of them are spending on the same things. Trump made a major part of his reelection not touching Social Security. So as long as that's the case, I think that if we see interest rates continue to rise, and eventually I think, someone's going to say, U.S. Treasury debt is not fairly valued, or at least the interest rates are not fairly calibrated for the actual risk of not being paid back. We could then see a real squeeze. And if that squeeze happens, you might see higher levels of inflation. You might see, long-term yields rise, that sort of thing. Ultimately, if there's no market for U.S. government debt, it's going to be bought by the Fed. The Fed's going to buy it. It's going to bloat its balance sheet massively, and that's a lot of money in the economy chasing, goods and services that haven't been, expanded to the same amount, and that means inflation. And so I definitely think that without some real heavy reforms and a fundamental reassessment of what the proper role is between individuals and the government, individuals in the state, we could see that sort of thing, and assets like land and silver and gold and maybe crypto, those sorts of things would only benefit from that sort of an event. It would be very painful. It's not something I want to happen, but if it did happen, the people with gold, to some extent or another, are likely to be the ones who are rewarded most.
Yeah, you and I, we've been around the block, and I was having this conversation literally 20 years ago when I was a student back in Boston. And we were discussing what is going to happen with this. Like we could see these unfunded liabilities. What's going to happen? And basically, the conclusion was, as today, that there was just not the political will to address the problem. We're just going to inflate the problem away, and not really away, just push it along for a few more years. And it is so bizarre looking back now as to how nothing has happened. It's just, and also, but one other sort of weird element was that during the 2008 global financial crisis, there was a great deal of liquidity pumped into the US economy, and we all assumed that this would lead to huge inflation, but it didn't really. It was some, but are we getting to a point where we actually could see double-digit inflation in the next few years?
We came very close to it in the summer of 2022. We came to 9%. And that's one of the things I tell a lot of people is that, we've been conditioned, especially those of us who have Austrian training, to think in terms of extremes like hyperinflation in, Zimbabwe or in Weimar, Germany. But what I always tell people is, I just came back from a trip to Africa, and I spoke with people there, and they'll be the first to say a mere, and I mean mere tongue in cheek, a mere 10 to 20% inflation will ruin your life. You don't need hundreds of percent, 20% year over year, 3% a month, that kind of thing will absolutely destroy your business. It'll destroy your life. So, we don't have to worry about hyperinflation type things. And the only reason we didn't have the kind of hyperinflation or the high inflation that we thought we would have in 2008, 2009 is that the money was released and the Fed began paying interest on reserves. And that kept a lot of that money from being redeployed. As a matter of fact, if you remember, the recovery we had from the 2008 recession and the financial downturn was extraordinarily weak. They call it a jobless recovery. And part of that was because banks were basically holding all that money back. Now, if they would have pushed that money into the economy and fostered higher growth, would we have seen higher inflation? We certainly might have. But the Fed, I don't have to tell you this, Fergus, I know you know this. The Fed is absolutely diehard set against any kind of deflation. They would always prefer inflation to deflation. And for that reason, they're always going to do the kinds of things that expand, whether that means balance sheets, whether that means financial assets, or it means actual prices. They definitely made that choice during COVID.
Right. Now, let me try to bring this back to gold. So I agree with you. Basically, I don't see any will in the United States. And in fact, in Canada, I think there probably is more will because there's this tension between the provinces and more kind of like pushback against the central government. So, and back in the 90s, Canada actually did go through a liberalization or a cutback. So they've shown they can do it. They've done it before. But I don't know. Some people might claim that during the Reagan era or during Gingrich, there was some cutback, but very limited. So now, one thing though about the gold era we're living in is that it is evolving rapidly in that there are all these different ways to hold it. You don't have to just buy it. Well, you can buy physical coins and hold them. That's one approach. That's probably, so long as you've got some security in your home, that's one of the best ways to go. It's less liquid that way, but in your book, you discuss all these different options, right? You're buying a gold ETF, getting these streaming or royalty companies, and what are the other options you address?
So, there's certainly the ETF route. There are gold certificates you can buy. There are certainly some people think that if you buy it, now this is a very roundabout way of doing it. And if you want, again, I'm not a financial manager, but if you want to expect, access to gold or at least proximity to its returns, I wouldn't go about buying gold mining companies, but some people do that. The thing is, the difference between all these different ways of owning gold is the extent to which, or should be the logic for which you own it. If you are buying gold because you want exposure to those returns, you can do it via an ETF. You can do it via a gold closed-end fund, that sort of thing. But if you are buying gold or own gold because you want to hedge against, the chance that, something fiscal or monetary will break and, change our lives, then, that suggests that you want actual exposure to gold. You want the actual physical metal, to whatever degree, whatever percent of your holdings. But that's a different reason for owning gold. So once investors realize why they want to own gold, is it just to get access to, periods like the last 6 months? Is it to actually be hedged physically against, financial uncertainties? That would dictate to some extent the way in which one would go about investing.
100%, because it's almost as though buying mining shares, right? Like, although there are juniors, producers, what have you, there are different ones. It's almost the opposite of buying physical gold for yourself.
Yeah, absolutely. That's the thing. Is like, when you own gold, you own an asset. If you own physical gold, you own an asset in bearer form. What you have is what it's worth. But once you start doing things like owning an ETF, or moreover, when you own a gold, shares of a gold miner, you've got counterparty risk. You've got the chance that, even if this is a great gold mining company, it gets managed or something like that. You've got a host of other of issues to deal with, more than if you just owned a small coin or a bullion or something like that.
Now, but just to clarify, what kind of rates are they charging for these for the storage or racking, whatever you want to call it?
I'm not sure what the actual rate is, but it compares pretty favorably with other mutual funds. They're not really doing a lot of management. They're just sort of moving around gold, and I think they may own it sometimes in the futures form before they get the physical. They do exchange for physicals. But one thing that's been really important about GLD and the ETFs is that they have been responsible for smoothing out a lot of gold flows. because typically gold flows are sort of volatile. There may be a mining company that discovers some, and so there's a period of time where it's being pulled out of the ground, and then there's nothing happening for a while. The ETFs have helped smooth out those flows, which is why we've seen lower volatility in gold over the last, say, 5 to 10 years.
So there are huge advantages to the ETF approach. How much investigational concern have you had, or devoted towards the concern that there is, let's say, paper gold, that there are more people who quote unquote own gold than there actually is gold in existence?
I've definitely heard those concerns. I've never really looked into them, but I mean, that is the kind of thing that drives people to want to own physical gold. That's the kind of thing where people would say, GLD sounds great, but unless I can pick it up or hear it clink when I put it down in the safe or wherever I keep it, I don't have a lot of faith. So if that's something that's a legitimate concern, if that's something that someone is reasonably concerned about, the way around that is to own physical gold.
Yeah, I'm going to have, I know there are gentlemen who are experts on this topic. I'm not an expert on that, about whether there is paper gold floating around, basically more quote unquote ownership than there is actual physical gold. I'll get one of the experts on, because I do think it is quite likely. And from what I've heard from people who are experienced in the industry, they suspect that it is.
That would be a huge, if it turned out to be true, that would be a huge blow for the paper, for the ETF paper gold ownership method. That would drive a lot of money into the physical gold, which would probably be good for those prices.
Well, you can see there's such a huge temptation to engage in almost like fractional banking of the modern era. Yeah. Now, this is going to be the question that everybody wants to hear, really. How much of a competitor or substitute is Bitcoin to traditional gold, the precious metal?
So, Bitcoin was originally framed as digital gold because it bears a lot of similarities to gold. It's got fixed supply, you have resistance to debasement, and you have, its independence from sovereign monetary systems. And in theory, those attributes suggest that it could serve as a hedge against inflation. It's a hedge against currency debasement, that sort of thing. But in practice, Bitcoin has behaved a lot more like a high beta risk asset, in which it responds to liquidity conditions, real interest rates, and shifts in investor appetite for risk. So unlike gold, Bitcoin more and more sells off during periods of financial stress, rather than absorbing them. So that behavioral divergence has really sort of weakened the claim that Bitcoin functions as a digital gold or a technological monetary safe haven.
Why do you think so many major institutions now, though, are holding cryptocurrencies in their portfolios?
The returns became too large to ignore, right? I mean, if you look at Bitcoin from 2000, even if you don't start in October of 2008, if you look from, say, 2014 through 2021, I mean, it's tens or hundreds of thousands of percent. And I think that it became too big to ignore, I mean, in the same way that I really shouldn't use this example because I don't view Bitcoin this way at all. But, in 1999, there were asset managers who said, I don't know why it's valuable, but I really have to add some Beanie Babies to my portfolio because they've gone up so much. So Bitcoin is not a Beanie Baby, but I'm going to say that the financial industry, especially financial market companies, there's a point where they have to get on board. Just because if they don't, looking back years from now, they could be very embarrassed.
But are we seeing a situation of the greater fool theory? I must admit, I'm concerned about that there's just this assumption that there'll always just be one other fool to come along and join this market, even though we don't really know what the use is.
I think that's the case for many, if not most, of the altcoins and other coins. I've thought that about Ripple. I've thought that about other coins. About Bitcoin, no, I think it's a little bit different. It is a unique financial prospect. I mean, that doesn't mean that the downturn we've seen recently couldn't continue. The market may decide at some point that $40,000 of Bitcoin is the right value or the right value for now. And so, this eternal, upward march to 125,000, $500,000 million of Bitcoin is by no means guaranteed. Absolutely not.
Yeah. Okay. And what, let's say, takeaways, because many people have addressed gold over the years, what distinct angles or perspectives do you think your book brings to this discussion that have been missing in recent times?
Well, I mean, I think that a lot of people have seen what's happening in gold, and I think they've thought that this is just a leg up, that is something being driven by, very simple sentiment. But there's a lot going on behind the scenes. I really think that when we look back years and decades from now, the decision of the Biden administration to kick Russian banks out of SWIFT is a huge change in the mentality, and it really changed the trajectory of the global reserve currency status of the dollar in the long term. And that, I think, has been a major role in causing central banks and large financial institutions to start buying gold, for long-term storage. And that's what's pushing up on prices. It is really a hedge now, more than it's been in a very long time.
Peter, that this is a real change to the gold market. It's a pushing of Russia out of the SWIFT system. It has politicized international transactions. It has politicized use of the US dollar. And it is, as you say, a structural change. Now, Peter's book is Gold in Uncertain Times. It is available on Amazon. Also, if you want to get more of his work, go to AIER.org. He is also available on X. If you want to follow him for more ongoing updates, it is at Peter_C_Earle, EARLE. Any other place people should go to learn more about your work, mate?
No, that's it. AIER is the big place. I'm very sort of sporadic with my posting on X, so I might do 5, 6 in one day and then nothing for a few days. So
sure, Peter, mate, I just appreciate the work you're doing. It's just this very important role of raising awareness about the importance and history of gold and how it's becoming more relevant now than ever before, basically. And so we thank you for your time, mate, and I look forward to finishing off this book.
Thank you, sir. Good talking to you.